All right, guys. We usually start off with a bit of a market update. I just wanted to bring through a couple of things that have, really not sitting well with me. One is the market update of the share market. As you know that, I invest in shares. I'm not invested at the moment. I am waiting for the true effects of COVID to really come through the economy, and, a lot of these companies are going to come out with balance sheets when they have to report, and they're going to report basically losses. They're insolvent, most of them. But what didn't really make sense is Westpac came out today and said that, 70% below what they forecasted. Definitely go check it out. I don't want to spend too much time with, the market itself. But I just want to ask you about how this makes any sense. They announced that their earnings are 70% less than what they had forecasted. And they also have a potential $1 billion money laundering suit as well. And they've also gone no dividends. Okay? They've announced all three things. It's become evident today, yet their share price goes up by 3%. Please, someone explain that to me. That doesn't make any sense to me. There are no fundamentals that support what's happening in the market, and that's why, for me, it's very risky to be in. Again, this is non-financial advice. Everything is general in nature and is, purely my opinion. But I am not touching that share market because for me, it just screams corruption. It seems like, when you look at how much debt is in the system, companies buying back stocks, there's just a lot of wishy-washy business going on there. And something I don't want to touch. So I did want to speak about that. There's no real common sense at the moment. We had something like Afterpay go up by almost 30% just today. I know there was some announcement there with a Chinese company being involved, but I don't know. I don't know what's going on. The other thing I wanted to talk about was JobKeeper payment start. So for most of you that are on here, you may not know what JobKeeper is versus what a job seeker payment is. So job seeker is fundamentally, a Centrelink payment that's just sort of, doubled up with the Corona support. Whereas JobKeeper is for anyone that sort of runs their own business or company, and they hire people. So they're at that forefront where they get to pay employees or themselves. So that's part of the payment I'll be on. But basically, JobKeeper, the problem with it is that we really haven't seen the full effects of the virus yet. Now, someone like me, everyone here probably knows I'm also in the wedding business. And so wedding and entertainment is pretty much dead. Bars are closed, nightclubs are closed, venues are closed. So a lot of these businesses have been affected in hospitality, and so they end up getting about a $750 payment every week. Now, the problem is that it ends in 6 months. Now, in 6 months' time, we're in probably, October, November, I believe. Well, 6 months, no, sorry, my bad. 6 months takes us to about September, I believe. Anywhere from September to October. And the problem with it is that we're really going to feel those effects in the coming few months. And then we're going to have to go, well, we're still going to be social distancing, right? So how does a bar operate? How does a restaurant operate? Where they have a full capacity of, say, 150 people, now they can only fit 40 people in there. So we're really going to see some sort of something break here. We're really getting to a crossroads there. And this is why I've been saying that when JobKeeper and JobSeeker and all the repo markets was happening, I really had said that, we haven't even seen exactly what they've printed yet. We're going to go into heavier debts. We're going to go heavier into the stimulus payments. And, it seems like every week there's some new stimulus payment being made, announced. I also saw there's a lot of the construction, projects that they had in the pipeline. They're now bringing them forward, job creation, and get everyone back to work as soon as possible. It's very interesting because you can go back to work and the economy can start functioning, but I think the government is really scared with what the forecasts look like. Dropping by the amount that they're suggesting we're going to drop by in terms of the economy and the GDP is very scary. I think it was about 8%. A contraction in our economy. Now, that's like, for anyone that knows how economics works, that's massive. The numbers that are coming out from the European countries are scary, and that's why I say, like, you know, if you look at the news now, everyone seems to be, you know, fairly lighthearted. Things are going well, but I don't think we've seen the full effect of this. I don't think we've seen the bottom of the market in terms of the share market either. The share market is purely driven by what the companies are doing, but there is a lot of, you know, in the back end company buybacks, and, you know, where's all this money going to go? Like, some people don't actually need the you know, job seeker payments or job keeper payments. So are they investing that, you know, extra money into the share market? We haven't even seen what the effects of people releasing their early release of super come through. So yeah, I don't know how one can sort of convince themselves that they want to go into the share market and buy, you know, $5,000, $10,000, $15,000 worth of shares when you've got so much uncertainty. But anyways, that's where we're at. I think the Q2 and Q3 projections of the global economy and how much it's going to contract is tragic. The numbers are scary, and, you know, I guess 99% of the population will not know until they're faced with issues of food shortages, or, you know, they're directly affected by it. And when you actually look in the back end, I was on, you guys should note this down, go into trading economics. Trading economics, just type it into Google, and you can check out Australia in terms of interest rates, in terms of what goes out, what's exported, and yeah, a lot of good stuff there. If you're interested in sort of educating yourself, it's called trading economics. Okay, so let's get to the main stuff. Let's get to the juicy stuff. The market's always going to fluctuate. It's always volatile, but I can give you some value here. Okay, so where I am fundamentally confused with a lot of people out there is, how can you basically rely on someone telling you that you can retire at 65? So the way it's been created, a traditionalist view on how people should live their lives is go to school, go to uni, get a good job that pays well, pay your taxes, and then you're going to buy a house, then you pay down the house, and then you save. And meanwhile, you're just plugging in money into your super, right? It's all, you know, it's compulsory, paying that through in the background. So then you get to 65, and then you can retire, and you can retire on your super. Now, if you look into the actual mechanics of how super works and how much is actually required for you to live from, say, 65 to 85 or 95, you're going to run out of money. It's just put simply, you'll run out of money. So, for example, people that are retiring, you know, this year, a lot of these banks are now, or, you know, a lot of companies are saying we're not going to pay dividends, right? So you may not know this, but a lot of retirees, a lot of people who've, you know, got their super, it's all invested somewhere, they make some income, they may not necessarily have invested in residential property. So apart from the home that they live in, they've invested into shares because they get a dividend yield. They've invested into, well, in their banks, they keep it in the, you know, saving interest, saver maximizer or whatever crap they call it, savers maximizer account, and they earn like 1.8% introductory offer, 2%. It's a load of shit. So that's how, you know, they sort of use that money that's existing there to generate more income. Now, fundamentally, it's screwed because it's not enough to live. And now that we're living, you know, even further into our 80s and 90s, you've got to think a lot of the guys up here, you know, that are in here, we're pretty much aged between 20 to 35, right? So that means in another 30, 40 years, where are we going to be at in terms of age expectancy or death expectancy, right? Where are we going to be at? I think we're going to be closer to 100, 110. And so if you're retiring at 65, what the hell do you do for 50 years? And it's all well and good you can find something to do, but does that mean you're going to actually spend that more time working? Because you're not actually going to have enough money to survive. So what I've been really big on, and once I understood this, I was like, fuck super. It's a lie, it's a scam. I'm not going to be told that I can retire only after 65. I control where I spend my time. I control how I take, you know, the choices in my life. I don't rely on the government to tell me when I can do that. So for me, it was very empowering to hear that I can go and have alternative options like investing in real estate, because fundamentally it is shelter that you're providing. It's a fundamental supply and demand of economics, right? So if you don't know what that means, guys, really get educated. Now is the best time. You're spending a lot of time at home, and it's okay to be watching whatever crap you want to watch, like Too Hot to Handle, I think is the new latest show on Netflix. You can spend that time, but you can also spend time 10, 15, 20 minutes a day, and you're going to find that you're going to be a lot more educated, especially when it comes to money. And look, at the end of the day, if we're spending, 80% of our lives working for money, let's be real here, is that not important to you? Like, are you simply going to accept that I'm going to work for 40 years and then retire based on someone else telling me when I can do that? It doesn't sit well with me, and I don't think it should sit well with anyone, but it's everyone's choice as to how they want to do that. But basically, if you're 25 now, in 40 years' time is when you can access your super, okay? So 40 years. So if in the next 5 years, you were to purchase, just say, one property every year for 5 years, okay? So that's one a year. If each one rented for $300, that's $1,500 a week. That's $75,000 a year. Could you retire on $75,000? Yeah, you could. Like in today's value, $75,000, let's say your house is paid off, right? You could retire. Now, where I'm basically going to give you the biggest hack here in this live session is reducing your working life from 40 years to 25, okay? You've just saved 15 years just by being here. So congratulations. I'm going to tell you exactly how. So what you do is you build asset, like you acquire the debt, and say you've got 5 properties and you acquired them in the next 5 years. It would take you from the point that you finished acquiring the assets you require, 25 years from there, and you're done. That's it. Like, you will have assets that have paid off, you'll have them providing you passive income, and that's $75,000 a year that's going to come in. Happy days, right? It is as simple as that. Now, can you get there quicker? Yes. Can you accelerate the process? Yes. Are they advanced strategies? Yes. So a lot of these things are, you need to spend time to understand context. I'm very big on context. I'm not someone that's non-transparent at all. I want to give you a reason behind why I say something, because it's all about education. You'll see in the title of Search Property, yes, we are buyer's agents, but we are also a mentoring company. I want to provide education. I want to provide mentoring, because a lot of the guys that are, asking me questions, either friends or non-friends, I feel for you. Like, we never got taught these things, and now is time to take accountability to really get wired in. This is the best time to do it, and I'm telling you, it's gonna go away. I'm not saying you're stupid for not understanding this. I'm just saying the system has put us in a place where we just sort of accept not doing certain things. Like, hey, maybe I should learn how to do my taxes. Or we go to school for 12 years, we go to uni for 3 or 4, and they still haven't taught you how to fill out, put in your own tax returns. They don't tell you how you can invest in certain things and how it could work. They don't tell you any of that. And the reason they do that is because, well, they want to keep you a slave to the system. Teachers are really funny. They usually go, well, don't make mistakes. Do the right thing. Truth is, in life, you're going to learn a lot more by making the mistakes than having someone insulate you. Okay? But I digress. We will continue on to what I think people could do. Look, in terms of assets with the debt, now I need you guys to understand something. The last time interest rates went up was in 2010, okay? So GFC happens in 2008, 2009, our interest rates go down, right? Then they tried their hand at going, no, we know what we're doing here, and the government tries to put up the interest rates. Now they try a few times, and then they failed. So then they had to bring it all the way back down. Now, if we haven't had a rate increase in the last 10 years. We're in 2020 now. The last rate increase was in 2010. How are you guys asking, or how is anyone asking, or how is the media saying, no, the interest rates will rise in the next 3 to 4 years? Like, I have brought out a video about the forecast of what I think is going to happen in the Australian property market, and I've spoken in depth about what the RBA can do and can't do. They have no option but not to increase rates. It's fundamentally flawed, and so anyone thinking that, oh, well, yes, we're going to increase rates in 3 years, so what am I going to do? Well, in 3 years' time, your situation's completely different. What's going to happen in 3 years? Well, just because you're thinking about what's going to happen in 3 years, imagine you did that 10 years ago. So in 10 years ago, you're going, I'm not going to invest because, I'm not going to invest because interest rates are going to go up and then I'm going to be screwed. Imagine you did that 10 years ago. In 10 years, we haven't had a rate increase. This is something to be very aware of, and Trading Economics is a great site to, sort of check out, because that's where they have a lot of this information. Now, that leads me on to negative interest rates, and I'll loop back around as to how this will really apply to you retiring through property and retiring on your own accord. Having a life of choice is the key here. So with negative interest rates, right, the whole thing is like, what? Negative interest rates? No, that could never happen. Cash rate will never go below 0%, because it can't happen, right? Our government will never let that happen, because it's basically like an upside down world where they are going to pay you to take out a loan, which means if you put your money in to save it, they are going to charge you interest for keeping your money in there. It's the opposite of what's happening or what's ever happened, right? So I know for some that's like, that makes no sense at all. Look into it. Because it's basically whatever you thought happens in a bank, it's basically the opposite of that, okay? So now we know negative interest rates is possible, it's gonna happen. Tomorrow's a rate, RBA has a meeting tomorrow where they may announce a rate cut. Now, I'm about 50% sure today, after what was happening in the share market, I'm probably about 20% sure they're gonna cut. So 80% they will hold, 20% they'll cut. If you asked me yesterday, I was at about 80% cut, 20% no cut. If we don't cut tomorrow, I think we're at 100% we're going to be cutting in either the June or July meeting. So June or July, we're definitely getting a cut. So we will be at 0 by the end of July. Whereas I don't think we will cut tomorrow. It's up in the air. A lot of the stuff that I look at, the indicators are all suggesting there is a cut, but there's a gut feel there that we won't cut tomorrow. But it'll be interesting to see. However, if you think negative interest rates are stupid, if you think they are unheard of, and they could never happen, check Japan. Japan for the last decade has been in negative interest rates. Okay, this is happening. You just aren't aware of it. And it's like, I'm not blaming you, I'm blaming the system, but now is the time to take accountability, take ownership of your knowledge and education. If you're here, thank you that you rely on me for that education input. But there are a lot of things that you can look up online. Spend some time, maybe 15, 20 minutes a day. It'll definitely provide you some value. So now we've provided some context. Now we get into the juicy stuff, right? So if you've now purchased, your 5 assets, they all produce the $300 a week of income. You're now at $1,500 a week. That equals $75,000 a year. You've knocked off 15 years of retiring. Your retirement age has come back 15 years. You've just gotten 15 years back. That's massive, right? If you're 30, you've just basically got 50% back of your life, right? That you've just lived, which is, phenomenal. Now, if you acquire debt today, you will pay the debt down in tomorrow's value. Now, what I mean by that, and the simplest way I can explain this, is if you bought in Sydney, say 20 years ago for $100,000, right? You bought a really nice place in, say, 5 Dock or the Inner West or something. So 100K 20 years ago, and you bought that property. Now, if you never paid down the principal and you just sort of went, I'm just going to pay the interest only and just get away with it. So you kept paying interest only for 20 years. Your debt today is 100K, okay? Now, you and I both have just had a moment of realization that if your debt is still 100K, right now, most people make 100K as their annual salary, right? When I say most people, like, you know, it's a lot more people making 100K. So if they're making 100K now and they say 50K a year, well, they could technically wipe out the entire loan in 2 years, okay? You get what I'm saying here? I'm saying that today's debt will mean shit all when we've got inflation come through and the buying value of money is pulled down. It means that today, if you go, oh my God, I've got $1 million of debt. Oh no, I'm stressed out, right? Today's million is gonna feel like peanuts in about 10 years time. Because after this deflationary period, we will get inflation and we will get hyperinflation. And with that, if you've seen any of my videos, I'm very bullish on, and I think it will happen. It's just a matter of when, not if. And what will happen is your debt that you have now will actually be what creates wealth for you. So if you, as an example, if you had $1 million worth of debt and interest rate was 3%, that means you'd pay $30,000 a year, okay? 1 million debt, 3%, $30,000 a year. So when the rates go down by 1%, you've just made $10,000, okay? When they go down by 2%, you've just made $20,000, okay? So now we've understood that 20%, so 2% goes down. So that would mean if you're getting an interest rate of 3% now, you're going to get an interest rate of 1%, say in the next year, 2 years, which I think is very likely going to happen. You've just made $20,000 on top of what you're making. So if I'm in a cash flow position right now of making, say, $60,000, well, I can add another 20 to it, and I could either use that to retire or to go part-time in the work I do, or I could use that to pay down my loans even quicker. Now, if your debt is cheap today and it means nothing, it means shit all in 10 years time, why would you pay off your debt? It makes no sense. So for instance, now in my position, I've got about $3.2 million worth of debt. To some, that sounds like a shitload. For me, I would love to get more. So, I'm trying my luck. But let's say $3 million worth of debt. Now in my case, if we have a 2% decrease in our interest rates, which I think will happen, I suddenly go and make $60,000 straight like that, right? Now, my repayments have been reduced by $60,000 a year because my interest has gone down. And that means fundamentally, if I felt like I was in a position today that, I would love another extra $1,000 a week in a year or 2 years time, I will be there. And that's only allowed because I have debt. Debt is actually good. We have been taught wrong in school. We've been taught wrong in the universities and by wrong people. Our traditionalist people, these fake teachers, are people like our parents, have great, hope for us and have great intentions. But the truth is that they've grown up in a different era. They aren't in the same era we're in. They're not experiencing coronavirus, being stuck at home. They're not experiencing this. And their age group, they're at a different frame of mind. We should be taking advantage of the fact that they've established themselves in homes in Sydney or Melbourne or wherever you guys are watching. If they've now purchased that property and they've paid down the debt and the asset has gone up in line with the fact that there's been no rate cuts and all this inflation's coming into the back end of the system, that's why the price has gone up of these assets. If that's the case, watch my last video I put up on YouTube. Get that equity out. That equity is sitting there and it's doing nothing. And if you're gonna just go, hey, you know what? It's not my problem. My parents, I don't want to have that conversation with parents. Well, you know what? You're going to have a couple of people affected here. One, your parents, because if they aren't using that equity to do anything, they're going to be in a shit show if they haven't figured out what they're going to do at retirement. Because I can tell you now, Super's a lie. They may get through depending on what age they're at, but I don't believe in it. So they need to take control, and if they aren't, because they're like, I don't like debt, they just haven't been explained correctly as to how it works. They haven't been explained as to how they can take advantage of the system and actually use it to retire earlier. And for yourself, you're going to be the other party that's affected, because you're going to wait and be like, no, I'm not going to do that. I'm not going to have that conversation. I'm going to save up money, and you're going to save and you're going to save, and you're going to be disappointed in probably about 3 years when you're going to look back and say, shit, I should have taken advantage of it. Last year, the 5th biggest bank was mum and dad. So what I mean by that is people were borrowing from banks, and they were borrowing a lot more. The 5th highest in terms of how much they borrowed was from mum and dad. So they were, giving, deposits. They were providing savings, giving gifts to their kids, because there is no way that you will enter the property market if you haven't got things lined up. So you're going to get affected, and in turn is going to affect the future generation. So your kids, and the choice that you have when you have kids. 15 years ago, having one person work in a household was normal. Now, if you don't have 2 people working, you can't afford to live. What's going to happen next? A lot of people are going to be living under the poverty line, is what I think is going to happen. And I'm not saying that to scare you. I'm giving you a reality check, because we've been taught the wrong way. Now is time to take advantage of the fact that you can learn the right way, get educated, because we've got to reset. The virus has actually brought in a lot of hope for millennials, and I hope that you take some advantage, take some action with it. But fundamentally, debt is the way you're going to get out of this. And it's counterintuitive, but everything you sort of think is wrong, or you've thought, oh, well, someone told me it was wrong, so now I've accepted it. It's actually the opposite. And if you don't move where the 1% will move, and you follow like sheep, 99%, then you will get those results that the 99% will get. And look, the government will still help the 99%. We are going to get stimulus. But the fact is, the reason why the rich get richer is because the government can't go, oh, well, I'm not going to help these people, I'm going to help these people only. They have to help all of them. And so when you benefit from it, you're going to have assets, you're going to ride them through, economic downturns, you're going to have equity there to then rebuild again. And these things happen every 10 to 15 years. It's a fact, it's history. The virus induced the financial crisis this time. There was, subprime mortgages for the GFC. There was something else before that. It's always going to happen. And so if you can ride out the wave, and this is the best time to do it, because you probably got the next 10 years of economic prosperity to either grow a business, take control of your finances. If you can really get ahead of it now, you got 10 years of this, right? 10 years. And you're probably going to get it a lot like that once the inflation kicks in of all that money they've been printing in the background. But it's an exciting time if you can take action. If you fall on the other side of it, good luck. But I'd leave you with that, guys. Thank you so much again for another session. Really enjoy that had so many people watch last week and this week. If you haven't already, subscribe to the YouTube channel. Putting up videos, every week, 2-3 videos a week. So a lot of value there. Share it with your friends and family. I think now that we're losing those restrictions or easing them out, let's have the strategy sessions in person. I'm keen to sort of sit there with you, and we can sit there with your parents as well. Just, look at the holistic plan. How do you guys all benefit from this situation? And it's complementary. So guys, that's it from me. I'll have another video come up in a couple of days about super and how you can use it to your advantage. But peace out and be safe. All right. So I'll catch you guys in the next one. Thanks, guys. Guys, thank you so much for joining me again. If you've watched all the way through, then please do leave a comment or at least a thumbs up if you've enjoyed it and got some value. I love doing these live sessions. It's a bit interactive, and I get a few questions come through after the session. So if you haven't already, follow the Instagram page. I'm posting there 3, 4, 5 times on my story with relevant articles, with relevant information that's up and coming. It's live data, so you can really benefit from being on the forefront of this, okay? So subscribe if you haven't, and I'll catch you guys in the next video. Thanks, guys.